Good afternoon, everybody. Thanks for joining us today in our webinar titled Long-Term Care Challenges and Solutions. My name is Daniel Goodman, and I am the Director of Planning and a Wealth Advisor here at Sierra Pacific Financial Advisors, and I will be your moderator today. So to keep this webinar more interactive, we do encourage you to submit questions through the Q&A box kind of down there on the bottom bar towards the right. The chat function is disabled. We also take your feedback very seriously and hope we always look for improvement. So we would really appreciate it if you would complete the survey at the end of today's presentation. So with those household items taken care of, I'd like to introduce you to our speaker today, Mr. Tim Bielig. Tim serves as a managing principal for Vanbridge in the Life and Executive Benefits Division. Tim began his career in the industry in 1999 and went on to co-found Truemark Insurance, a Bay Area-based boutique insurance brokerage firm, overseeing sales and marketing activities with financial advisors, property casualty brokers, RIAs, and independent life advisors, providing retirement, business, and estate planning risk management solutions to high net worth clients. So without any further ado, Tim, I turn the stage on to you. Thank you very much.
Thanks, Daniel. And thank you for those that signed up to join the webinar. Hope you all had a good Memorial Day weekend, and I hope you find this time useful for you. Like Daniel said, a lot of discussion around long-term care is something that is meaningful to a lot of people, whether you've had a family member go through it, you've heard of it, or you've experienced it closely. Something that could be have a big impact on your financial plan as a whole as you work with Daniel and Sierra Pacific to put those things together. So I put together a brief PowerPoint. The idea is to be educational and to inform you what's out there, no matter who you're talking to. And of course, Daniel and I can help if you want to follow up with any further discussion, but we'll want to jump back a few slides. We could start on slide 12, and that would make it a bit shorter. But as Daniel mentioned, my firm, Vanbridge, is owned by Epic, but we focus on working with financial advisors and using insurance solutions to handle risk, estate taxes, and things of that nature. And so long-term care is a big part of that planning. So this first slide here talks about just the need to plan. You may already know some of this, but the statistic that's the most eye-popping is that 7 out of 10 people 65 and older will require long-term care in their lifetime. So if you're a married couple, that's a coin flip where one of the two of you will likely need it. And this is a growing problem, such that there used to be dozens and dozens of long-term care companies out there, the biggest being Genworth. And with the baby boomers and the need for this, it has wiped them all out, where there's really just a handful of traditional long-term care policies available today. So this is a big need, and states have a problem too, as we'll get into that in a little bit. But some folks think, Medicare will pay for it. Medicare does not pay for long-term care. It gives you about 100 days of protection, and then after that, you're on your own. So the first 20 days that'll cover it if certain requirements are met, and then days 21 through 100, I think it's capped up to $195 you'll pay out of pocket per day, and then after the 100th day, it doesn't cover anything. So Medicare is not the answer to cover your long-term care. Medicaid, as we'll get into, that's basically a welfare program, a poverty program that the feds and states try to figure out how to help address the need. And that's the largest public paying provider for long-term care. And for Medicaid to qualify for that, you basically need to be at the poverty level from an income standpoint. And from there, you have the states determining how things will go. So we'll move to the next slide and get in. This basically shares what I just kind of highlighted, that there are certain rules and guidelines for Medicare to pay for part of it. And that Medicaid, basically there's strings attached, where if you try to dump all your assets and look like you're at the poverty level, they have a way to claw those assets back and make sure those things don't happen. So you do not want to rely on either of those to pay for this need. So the only other thing is use insurance or pay for it out of your assets. So we'll get into that a little bit. The bottom note there, which is expanded on this page, is the whole regulation that they're looking at. The state of Washington, in trying to deal with their Medicaid problem, how do we offset that? How do we use tax dollars to pay for long-term care to create our own long-term care plan? So the states are looking to figure this out. And so that created a huge surge of individuals running to the market to buy long-term care insurance, because Washington said, hey, if you don't have long-term care, a privately owned policy, then the state is going to implement a payroll tax of 0.58% on your annual wages. That's your gross wages, and there isn't any cap. And those taxes will go to fund a plan. Well, of course, what does the plan look like? Well, for Washington, it was around $36,000 a year of benefit, which isn't anything significant. And so California is looking to do the same thing, as well as a few other states. What can we do, and how can we raise money to help offset this obligation that's just killing us? And so California is currently in committee. They have actuaries and teams looking at how they can do it. And they're looking at the payroll tax, just as Washington did. And they're also looking at how that be paid for. Will the employer have to pay that whole bill, or will the employee eat that whole tax, or somewhere in between? And so it's something you're going to want to figure out. We don't know where it'll land, but history will show us they're going to, try to implement something. And then, of course, if you already have a long-term care policy that you've been paying for, you may be able to opt out. Well, in the case of Washington, they gave you runway. They said, hey, you have so much time to go find the coverage, and then you can opt out. Well, that created a big surge in the marketplace, and the life insurance companies, the long-term care companies, they basically had to stop selling in the state of Washington because they received too many applications. They couldn't handle all that risk. So states are looking at that also, because also if you run out and buy it, then they lose out on those tax dollars. So they don't want to give a long runway either. So what California is looking at is they may not have an opt-out provision if you don't already own it. So again, not a fear factor, but this is happening. And I think the dates I have down, September of this year, the actuarial report will be circulated for the state of California. And then sometime in January, that committee will make some recommended changes on how this may look. So that's up and coming. So enough on that. It's pending legislation. They're looking at taxing, and you may be able to opt out if you already have a plan in place. We'll go to the next slide. So when looking at long-term care, we touched a little bit about this already. Do you have enough assets to cover this need? And we'll get into some average cost of care on the next slide, but these are the questions you want to think about. If you went on claim, meaning you can't do 2 of the 6 activities of daily living, that's eating, toileting, transferring, bathing, dressing, or continence. So if you can't do 2 of those 6 things, then benefits are paid, or if you have severe cognitive impairment. So if the long-term care need were to happen to you today, how would you fund that? What would your spouse do? Are you planning your spouse to take care of you? Would you need to go to the kids? What if it happens to one spouse before the other spouse? And then, the assets that you might be using to fund this care are in the market. What if the market's down? What are you planning to do there? So one of the biggest killers in a financial plan of your retirement income assets would be long-term care because of the cost. So it's something to really think about. And lastly, on this page, how involved do you want your kids to be? Who do they call? How do they line up care? I had both sets of grandparents in my family need long-term care. All 4 of them didn't have any insurance, and I watched my parents deal with both sides and going through that. And it's almost like a full-time job, and there's a lot of stuff that comes with that. So something to really play out and think about in your mind: who would line all these things up, and how can I fund this? So here's the cost of care. That's actually 2022. Sorry, I didn't update that. But here's some values in the San Ramon area. If you are needing care, that's the annual cost. And so if you were in a San Francisco or LA or certain high-end areas, those costs could go up and significantly. And then as well as, you know, if you're going to be out in a remote area, it would be less costly. But this gives you an idea what things may cost. And there's a website I can send out after the fact where you can go in and put in the area you're thinking about retiring or living, and that would give you all these real-time numbers to look at. So it's a significant cost. And I think the average stay is 2.5 to 3 years in a facility or needing care. And that doesn't include what people usually do before they implement care, right? You're trying to battle it on your own, have your brothers and sisters come in and help and do things for a while. And then it gets to a point where you can't do it and you need professional care. So it's a costly thing that could last for years, depending upon the nature of the long-term care need. The next slide here. So if you're going to use insurance to fund the long-term care costs, as well as provide you with a care coordinator, when you buy a policy with almost all of these companies that are out there, regardless of which type you go with, one of the benefits is a coordinator to help you line up the services needed to go in and take care of things. Whether you're staying at your home or going into a facility, you have someone to call, or your child or spouse has someone to call to say, hey, what do I do? And help put those things together. So that's one of the biggest takeaways of having a plan. Even if you can't, buy a larger plan, just having any plan, one, it may help you to get out of the possible taxes they want to implement by the states. And number two, it gives you your family someone to call to line up care. So the three types of long-term care coverage that are really out there, if I could boil it down to three when talking about it. Number one are the traditional policies, where it's like a home policy, an auto policy, where you pay a premium. If you have the need, it'll pay benefits. If you cancel or quit or pass away, there's no value, there's no equity. Your coverage ends. And so that the traditional long-term care policies, there's not really many of those left standing, just because of the cost of care that they were hit with. A lot of them have adjusted their pricing. So perhaps moving forward, we won't see dramatic rate increases. But while you hold those traditional long-term care policies, those rates could be and have been raised over time based on experience. But that's one thing to consider. That is the lowest cost as well, because it's only paying if you go on claim. The next two are very similar in that they're using a life insurance policy as the basis for the long-term care need. Even if you're not interested in life insurance, you hate life insurance. Many people actually feel that way. But when it comes to long-term care, and once they understand how this works, they're willing to consider it. So it's a life insurance policy, a permanent life insurance policy with a long-term care rider, which means if you have a $500,000 death benefit and you pass away, that's $500,000 tax-free to your beneficiaries. If you're living and you have a long-term care need, the same definition applies here. Then you would have $500,000 of tax-free dollars available to pay for care while you're living. So now you have a life insurance policy with a living benefit to it. And the charge of that rider is much less than if you went out and bought a traditional policy. So for those of you that have a life insurance need, or that you already own life insurance, this may be something for you to consider, because you can switch your existing life insurance into this kind. So if you already have a permanent life insurance policy, many times you can leverage that policy you already have to get this new kind of a plan where you have a long-term care rider added to it. So if you pass away, $500,000 in this example. If you need long-term care, $500,000. But let's say you spend $200,000 for long-term care and then you pass away. Well, that net death benefit amount, $300,000, would still be paid tax-free to your beneficiaries. So the whole idea of if you don't use it, you lose it, we now have a benefit that's paid whether you pass away or you need the care. So now this turns into more of an asset, a bond-like asset class where there is a rate of return attached to it. You will pass away at some point. You may or may not need long-term care, but there is a return on those premium dollars you're spending. So a lot of the times I talk about, at age 85, if you were to pass away or need care, what's the equivalent rate of return? And it's usually 4 to 5% on your premium dollars. So we'll get into that a little bit. The third one down is the life plus long-term care asset-based, also known as like a linked benefit. This is for someone that has emergency funds set aside, 50,000, 100,000, 75,000, 200,000, a lump sum of cash sitting in a bank or an emergency fund that you haven't touched and you don't ever plan on touching. Another route to go is to take that lump sum, all of it or a portion of it, and make one payment into a plan like this. And in that example, you have immediate leverage for long-term care if you need it, usually 3 or 4 times your deposit amount. If you pass away, there's slight leverage. So maybe instead of, if you did $100,000 deposit, maybe your death benefit's $120,000. So you still have a return on your deposit. And third, if you quit, what if I need to bail out, something changes, I really want to make sure I have access to that money, then those types of plans have a very high surrender value, if not all of your money back. So if you did $100,000 deposit, your surrender value could be $100,000. So no matter what happens, if you don't lose it, you may not have any interest, but you'll get all your money back if you just cancel it. So these are the 3 different ways that you can fund the long-term care need. In the next few slides, I'll go through kind of what pricing looks like. But before we do that, when you have a long-term care policy, any of those types we just went through, you have an option, whether it's reimbursement or indemnity. And reimbursement, as you can see on the screen, means you pay for your long-term care, and then you submit receipts to the carrier, and they'll reimburse you. So that's called reimbursement, and that's usually the less expensive type of plan to buy. So the carrier's just reimbursing you for what you spend, and by a reimbursement policy, there isn't any limit to how much these policies can pay out. Based from a tax perspective. Indemnity is, we're just going to mail you the full benefit amount each month. So if it's a $15,000 a month benefit and you only had $10,000 of expenses, they would send you the full 15, and you'd have the $15,000 to pay for the, 10,000 of it for care, and you'd have 5,000 left over to hang on to for the next month or whatever you want to do with it. And in the indemnity programs, you're free to spend that money on, if you want to have a family member or someone come in and take care of you, you have the money to pay for it. Whereas reimbursement is reimbursing you only for professional care. So those are the 2 different types of ways to receive your benefits when you go on claim. So that will dictate which carriers, which plan type, and kind of narrow down. So if you really like one more than the other, then that would kind of help sort through which design we'd go with. Next slide. Okay, so we're going to go through those 3 types, hopefully not too painfully for you. But the traditional long-term care, I'm a visual learner, so the little hand with the money, those are the premium dollars you're paying, and the bucket, the gold bucket, is the long-term care benefit amount. So you're paying a small premium relative to the size of the long-term care bucket that you would need. So Daniel, if you'll hit the button one more time. For example, I took a 60-year-old male and a 60-year-old female, and I tried to run all 3 of these with around $500,000 of long-term care benefit each. And for the traditional policy, the most I could get was $480,000. So I'm just trying to give you a baseline of what pricing may look like. And there's a lot of moving parts that come along with it. But for a male 60, $500,000 of long-term care, that would be $2,400 a year, every year, for a traditional policy. And so there you go. For $2,400, you now have $500,000 or $480,000 available for care if you need it. And for the female, you see the price there. So for a married couple that are 60 years old, if they wanted $1 million, half and half each, it's about $6,500 a year. So what you don't have is the death benefit. If you pass away, just like your auto insurance and home insurance, there isn't any death benefit. If you cancel, there isn't any cash surrender value to you. And then you need to pay those premiums every year accordingly, or the coverage lapses. So those are the 4 areas I like to look at when comparing these 3 plan types. We'll go to the next one. The next one is the life insurance policy with a long-term care rider. So you're paying a little bit more premium, but now we have some other buckets appear. And so the gray bucket is, what if I quit? Well, for a basic plan, there really isn't a huge surrender value, but there's something there. So if you have the policy for 10 years and you pay a bunch of premiums, you will get some amount if you decide to cancel, but it's not really a big eye opener there. It's just some value. But that liquidity value can also help you make payments. So if 1 year you're not able to make the payment and you've had the policy long enough, there may be enough cash value in there to cover the charges for that year. So you have some payment flexibility, which is that green circle on the bottom of the list there. The blue bucket, that's your death benefit. So in this design, our blue bucket matches our long-term care bucket. So that's the example I gave you before. And Daniel, you can hit the slide one more time. Here's an example here where you have this two same 60-year-olds, and there's $500,000 of long-term care if they need it, or death benefit. And so you see the premiums for each is more, but you will have a return. You will pass away at some point. You may or may not need long-term care. So the thought here is, I'm covering both, and if I need it, I have it. So do you have to buy $500,000 of long-term care? No. These numbers you can divide by 2 for $250,000. So for $8,000 a year, you each can have $250,000 for long-term care if you need it. So this gives you the cost breakdown. Below that, I showed you what that gray bucket would look like, say in year 15. You bought this policy, you're 75 years old, you've paid $9,000 a year in the male's policy, and in the 15th year, there's about $71,000 of cash value in there. So you can see you have plenty of money to cover charges in the event you don't or can't pay the $9,000 in any given year. You have plenty of cash value to absorb those costs. And finally, the thing I point out, that's a lot of premium to be paying, but for the leverage you're getting, that's tremendous leverage. So if you were to take the same $9,000 on the male age 60 and invest it, and then at age 85, what is the equivalent rate of return that you would need to have obtained on that $9,000 of savings each year? That's 5.7% rate of return. So to say it differently, if you buy this policy and spend $9,000 a year and you go on long-term care claim at age 85, or you pass away at age 85, it's as if you earned 5.7% on your premium dollars. That $500,000 payout is like a 5.7% rate of return. So I'm always trying to do the math, to take emotion out of it. There's this need. How can we cover it? This is one way to shelter $500,000 of your assets by paying $9,000 a year on the male or $7,700 on the female. So this is, and there's ways to design this one too. You don't have to pay every year. They allow you to pay as frequently as you want to. So if you say, hey, I don't want to pay on this policy for the rest of my life, can I pay it up? Can I be done paying after 15 payments, 10 payments, or at age 70? Absolutely. These types of plans, because it's a life insurance-based policy, you have control each year on how often and how much you pay. You obviously need to pay enough to keep the coverage, but you have the flexibility where if you inherit some money or you have a bonus come in and you want to just pay it off, you could just write a check and pay it off, as well as skipping payments if you have enough cash value inside. So that's the kind of the second design. And the third design, where the money and the charcoal bucket should look similar in size, because I'm trying to tell you that whether you pass away, that's your blue bucket, you're leveraged. Whether you need long-term care, you're even leveraged further. Or if you just decide you need to quit, you're going to get most, if not all, of your money back. So whether you live, die, or quit, you have all three bases covered. And that's kind of the asset-based design. So if you'll click the button one more time, this is the example where you make a single payment of $170,000. And for that, you have $500,000 of long-term care and $250,000 of death benefit. So unlike the previous plan where your long-term care and your death benefit were equal, Here, we're giving up a little death benefit because we're really after that long-term care. So that's how they're able to do it. So again, the same math here, combining the premiums, what is my cash value in any given year if I quit? So in this case, you put in 173,000, and if you decide to quit, you get 121,000 back. That's guaranteed. So not quite 100% of your money in this example. The carriers vary. And again, comparing at age 85, what's my rate of return? If I would have kept that 173,000 and just invested it and then hit 85 and these benefits are paid out, that's about a 3.9% rate of return. So this is an asset based. This is designed to take a single chunk of money, or they will allow you up to 5 payments in some designs to put in larger amounts, with the idea being, hey, I really want that bailout provision where if I just quit and want my money back, I know that I have that security. So there are many carriers that offer the second and third design, where it's life insurance with a rider, asset-based. There are even annuity-based designs where life insurance is not any part of it. It's just an annuity that has a very low rate of return on the annuity, but if you need long-term care, that's leveraged much greater. Let's see what we have next. So hopefully this gives you an overview of long-term care, that Medicaid and Medicare are not going to be the answer. If you have tons of assets and you're not really worried about outliving those assets, this is still leverage. It still gives you someone to call to line up that care that you otherwise wouldn't have. So hopefully that was helpful, as well as the 3 kind of high umbrella. What are my options out there? Normally you'd want to see a price for the traditional, price for one of those 2 hybrid models or combo models. So Daniel, if there's any questions, I'm happy to address those.
Yeah, Tim, we got a couple of questions. The first one is, why does long-term care premiums for women cost more than males for the same age?
Great question. Women live longer. Men don't. And for that, they charge differently. So it's also based on age. But generally speaking, women outlive men, and there's greater likelihood that they're going to need the care.
Okay. We had another one about the Medicaid look back period. Like what's that? How does that work?
Yep. So basically, if you're if you're one person in a household, your gross income needs to be around $19,000 a year to qualify. So, if you're married, it's around $26,000 a year gross income to qualify for that. And so you would need, for those, the look back is for those people that try to get rid of assets. I think you can keep one car, your house, but your bank accounts and all your other assets have to be gone. And so people will get rid of money, give it to their kids, try to do gifting strategies, and then go file on claim. And that's why they have that look back period, is to be able to go claw back and say, no, wait, not so fast. You got rid of these things just so you could qualify. So they do that as a way to combat that.
Okay. I think you probably answered this next one, but the question is, if I have a traditional long-term care policy, but I never use it, is there some way to get some of that cash back, or no?
Yeah. So what I've seen when I've run into people that already have policies and they say, hey, because one thing we do is policy review. If you already have any kind of policy, life, long-term care, we can audit and review those to make sure they're current, compare them to what's in the market. So if you already have a policy, a traditional policy, they do give you some options where you don't lose your benefits. So all those premiums that you paid, they may give you a paid up policy. So if you paid $40,000 worth of premiums year to date, or since you took out the policy, then they would just stop the charges on your policy and say you have $40,000 worth of long-term care benefit if you need it. So you don't forfeit all your premiums. That's one route. The long-term care companies, they're looking to get you out of those plans. Some have mailed bills with rate hikes, and to avoid rate hikes, you can reduce your benefits, change your benefit period from lifetime to 5 years. So the carriers are looking for those opportunities for insureds to reduce their benefits or cancel altogether. So for that person that has the traditional policy, if you just stop paying, they should give you the right to at least keep a policy the size of your premiums paid, so you don't lose all that benefit. Hopefully that was helpful.
Let's see. The other question we have for right now is, oh, this is a good one. Who determines if I qualify for long-term care? Is that the insurance company?
Daniel and I do. No. Yeah, a qualified physician, medical professional has to qualify you as needing long-term care. So 2 out of the 6 activities of daily living or severe cognitive impairment. So that severe, it's not a tricky definition where these carriers are looking to get out of it. It's a standardized definition. A doctor in the United States, a professional doctor, has to validate the claim one time, and in some cases it's annually. It depends on which provider we go with, but it needs to be a U.S. doctor. So if you're overseas or somewhere else, you would need to come to the U.S. and get validated, or if there's a U.S. doctor where you're at, some carriers will allow it to happen over there. So yeah, they're not trying to wiggle out of it, but it's just a regular doctor that would say that and validate it.
And then another one we have is what happens if that insurer, that long-term care company, goes out of business?
Great question. So I have a Genworth policy and they don't offer coverage anymore. And it is bad practice for any life insurance company to go out of business and not pay claims of their policyholders, because we all as consumers want to believe in insurance. It's a good thing. It protects families and lives and estates. So what normally happens is someone would buy that block of business or take it over. So from what I've seen in my experience is someone comes in and buys it, and usually with that, there's often a decrease in service, right? If you need to call or make changes or ask questions, that's where the frustration can come in the event that the carrier you purchase from goes out of business, someone acquires them. So hopefully that doesn't happen. But these life insurance companies have been pricing mortality forever, much longer than long-term care has been around. And they know that everyone dies. So who better than a life insurance company to price morbidity as well as mortality? So you want to pick a good carrier, a strong carrier that we hope will be around so we don't have to, deal with that. But that's the short and sweet is I've seen them, they get acquired because no one would believe in the products anymore if these companies just vanished and all your premiums and coverage were lost. So I've seen them just get acquired.
That's all we have for now. So we'll kind of work on bringing this plane into a landing. So
that's who I am. If you have any questions, you can reach out to me there or just through Daniel, and we're happy to consult and follow up.
Okay. So thanks a lot, Tim. That was some great information. So everybody, we just wanted to give you a little bit of information about Sierra Pacific Financial Advisors, a little bit who we are and what we do. So we are a full-on holistic wealth management practice firm. So of course we do investment management, but as you can tell from the rest of the graphic, we also do retirement planning, which is the bulk of our business. We also engage in tax planning for our high net worth clients, stock option execution strategies. Living here in the Bay Area, we've got people who work for Apple, Google, Meta, and smaller public companies. We help them manage their stock equity compensation plans from a tax perspective, as well as a cash flow maximization situation as well. We help folks figure out their college funding, 529 plans, and how to do that also from a tax efficient and a FAFSA consideration as well. And as you just noticed today, we also do risk management and insurance analysis. Tim Belig is one of our key colleagues in working that part of the business. We also do charitable and estate planning. So with the Tax Act of 2018 coming to a wrap up in another couple of years, this is becoming more of a focus for our clients as the estate planning becomes more of an issue for people to start working on. And then also we do have a business to business component and a corporate retirement solutions for small and medium sized businesses. As you know, California now requires any business over 5 employees to have a retirement plan for those employees. So we're really working with a lot of small and medium sized businesses in that particular space to help them with that. At Sierra Pacific, financial literacy is our passion. So we do offer these complimentary informational webinars on a bi-monthly basis. So we've got 3 more remaining for the year. July will be solutions to concentrated stock positions. We typically see this with people who work for the company. So again, back to that Apple, Google, Meta executive or employee who's just been holding on to all of their stock options and exercise stock for all of these years. Help them to manage that. September will be direct index investing. I like to explain this as an upside down mutual fund. Mutual funds tend to have 50, 25 different stocks that create this mutual fund, and you just own the mutual fund. Direct index investing turns that around. So you actually own 50 or 100 of these stocks, and then the index is able to sell off as losses occur, which allows for immediate execution of tax loss harvesting. So it's a good way to increase your tax loss and tax planning opportunities with your investment dollars. And then lastly, in November, we'll talk about market cycles. We've had a big booming economy over the biggest boom for 10 years, and we're still kind of in there, although it's a little weaker than it was. So is a recession coming, and how do market cycles play into economic cycles? That'll wrap up our 2023 educational seminars for the year. If any of these remaining 3 sound intriguing to you, we would just ask you to go ahead and send us an email at info@SierraPFA, and we will be able to make sure you get registered for that webinar. So lastly, we'll open up for one last round of questions. We have a couple more that have come in, but just know we do have 3 different locations to meet people. Our home office is in Pleasanton, but we also have we're able to meet people in Cupertino as well as Oakland. And with all presentations like this, there is a disclaimer, which is all investments involve risk, including possible loss of principal. This material today is for educational purposes only and intended to be of general interest and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any particular investment strategy, and it does not constitute legal or tax advice. So Tim, we did have 2 more questions come in. One is, at what age should I consider getting some kind of long-term care insurance?
Good question. Basically, when people are about 45 to 50 range, that's when I bring it up, just from a funding standpoint. It gives you longer runway to fund it during your working years. So, without absorbing a big premium, if you're able to do that. So I'd say as early as 45, and then as late as 75. When you hit 75, there's very few products that are out there, and the cost of it doesn't make sense a lot of the time. So I'd say as early as 45, I would look at some numbers, and then, if it comes up again, ask for numbers again, and you'll see how over time these prices change. So the younger and healthier you are, if you go the life insurance based route, the less expensive it'll be. So if you have a life insurance need, then it's worth considering just doing it and adding this rider, because you've killed 2 birds with 1 stone. And the younger and healthier you are, the less expensive it is. So a general rule of thumb on the middle option, the life insurance with a rider, it adds about 8 to 10% to the cost of the coverage. So that gives you kind of an idea. If you just bought a regular permanent life insurance policy for $500,000, it would add about 8 to 10% to that. That's around where the cost is.
And I think one of the other questions we have is, so if California is going to require this long-term care insurance and I can pay it with pre-tax dollars, Why wouldn't I just do that? Isn't that going to be cheaper from a tax perspective?
Well, if we're going to go from the tax perspective, you're paying for something. If it's pre-tax, if it runs that route, then we look at the benefit amounts. And from what we've seen in Washington, what you're getting for that payment will maybe cover a year or two of care. So the leverage you would get out of a personally owned policy is much more significant than a state run policy. And for individually owned policies, there are deductions available. So there's what they call an actual premium versus an eligible premium. So depending upon who owns it. So if you're just an individual buying it, then it's age-based, and it goes into how much of it, I think you're allowed up to 7.5% of your adjusted gross income under your health expenses, your medical expense category. So if those premiums get up there, you may be able to deduct a small portion of that as an individual. For those of you that are business owners, if you're a C corporation, you can deduct 100% of the premium, and you can discriminate. So that means that the owner of the C Corp and his wife can have long-term care and fully deduct the premiums for long-term care coverage. If you're an S Corp, an LLC, a sole proprietor, then that runs a little bit different. You're still able to do some deducting, but if you offer that to your employees, they allow you to fully deduct it. So if you're the whole tax game, pre-tax versus after tax, it depends if you're an individual or a business owner of some type. But ultimately, the benefits that a state program will provide you and where you can receive care will not be as strong as a privately owned plan. Gives you more control.
Okay. All right, everybody. Thanks, Tim. So yeah, we've tried to address as many of the questions as we can. I think we got through pretty much all of them, but we are running out of time. So we will answer any remaining questions offline by contacting you directly. So I want to thank everyone again for attending today's webinar. Thanks very much. We appreciate it. Tim, appreciate your time today. Please note, as we noted, our financial webinars are on a bi-monthly basis. So please register for our upcoming webinars when you receive the invites. If you'd like to obtain more information on today's topic, we would love to set up an initial consultation with you here at Sierra Pacific. So please feel free to reach out to us by phone or by email. Again, I just want to remind you that there will be a short survey. I promise it's short. So we would appreciate if you just take a few minutes to complete that survey. Once again, everybody, thank you very much for your time today. We appreciate it. And we hope you have a great rest of your afternoon. Take care.